We did it.
It's a good
I
day.
have no idea.
It's a good day.
Like there's no rhyme or reason why YouTube works or doesn't work.
Giveth and taketh away.
The YouTube giveth and the YouTube taketh away. Cash on, y'all ready, big guy?
Let's go.
Hold on, let me just put on the chat here so we can do the proper roll call.
Yeah, baby. 9 days till summit.
9 days to summit.
9 days till summit.
Yeah. And welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Today, we are going through a real life scenario of how do you make property babies? How do we use cash out refinancing to create growth in your portfolio of number of homes without having to bring additional capital to the table? And we're going to use somebody very familiar to the show, his real life story, his real life portfolio, a real estate noob that's going to be walked through here. They're going to use my portfolio.
There we go.
Yeah, I'm your host, Pablo Gonzalez. With me, as always, here in studio, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
Good to be here in studio, GC, and it's good to kick off our weekly tradition.
Roll call, baby.
The leadoff hitter kicking us off today.
John Henning.
MVP batting second.
Mr. Lee Bishop. Billy Green.
Green from the dry mountains of Colorado. Good to have you, Billy. We got Saran with the plan.
Saran with the plan. Saran, your show was amazing. I can't wait for you to be at Summit and share more about you and your show. And oh man, it was so awesome. If you haven't watched Saran's show, you have to watch Saran's show.
You can tell Greg just rewatched it
I did.
a couple days ago.
I'm pumped.
He's into it. He's into it. We got Ilma Ishers in the house.
John Williams.
Future star of the show here. World famous composer from Long Island, New York. We got the early bird.
The early bird. That's 2 in a row with the early bird, man. Good to see you, Dean.
Back, Dean. Good to have you back. We got
Drew Barnhill.
Drew Barnhill. We've got, we got the KOB, King of the Beach.
Christopher Lee.
Mr. V from Fernandina Beach. We got the Shaman.
Nadeem Shah.
Nadeem Shah from the Pacific North, with his Pacific traditional greeting from the Pacific Northwest. Good morning. Good afternoon, JWB family. We got the Maven from the mountains of Denver.
Ms. Leslie Wilson.
Ms. Leslie Wilson. We got Belinda Baldwin from Dallas, Texas.
All right, Belinda, she's a friend of mine from a training that I did with the Kingdom 320 group yesterday.
Yeah,
so
nice, Belinda.
So nice to see you, Belinda.
Belinda. We got Laura Colby from Washington State.
Oh, it's wonderful to see Laura.
Welcome back, Laura. Mike Harden from Philly.
Another one of my buddies from another one of our affiliate groups from the Wealth Outside Wall Street group.
Making friends
you know what? You know my introverted self. I don't make too many friends. So when I make a friend, you know, I hold on to him.
Leave you alone for a second. We got Jackson Chu from Tuscaloosa.
Another friend of mine. I met Jackson last week. My priest actually introduced me to Jackson.
Right.
Wonderful guy, and I'm so excited you're here, Jackson.
I heard they got the collegiate institution over there in Tuscaloosa.
There you go.
Who else we got in here? Oh, our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
We've got a good day from a not your average guest. If you check in from your phone off of a text, I don't know what your name is. It just says not your average guest. Everybody shows up to say it. So whoever says good day to you.
Good day.
Sir or madame. Well, we got Linda Mercurio.
Oh, Linda's so great to see you.
Murrells Inlet, South Carolina.
Murrells
Inlet. She always checks in from South Carolina. I know she's from South Carolina.
I know Murrells Inlet. My grandfather used to live in Murrells Inlet. Yeah, I know it very well. What do you know?
World? Ain't that a small world? I like that. Abdul Hamid Ayub Zai.
All right.
Welcome to the show.
Abdul, very nice.
It is a tradition.
I think we would remember Abdul's name.
Yeah, it's a tradition that I butcher your name the first time you do the show. So you're officially in, man.
Welcome.
Our favorite smile from the Pacific Northwest.
Miss Pamela Myers.
Smiles from the Seattle area. Can't wait to see Pamela soon. We got El Gran Amigo.
Bill Shields.
With Buenas tardes desde Cuba. What else we got out here? We've got the fairy godmother in the house.
Ms. Jen Filson.
Miss Jen Filson, good to have you from the lovely Monterey, California. We got Venny Valsamakis, Venny. We gotta give Venny a nickname surrounding something around like her AI graphic creative and promotion of the summit. Venny's been doing daily countdowns in the Not Your Average Investor group chat. Really awesome, Venny. Really appreciate that. Getting the excitement going. I'm excited. Who else we got in here? Okay, Gary, Rosalind. Okay, everybody's saying hi. All right, GC. I know I've heard that. Beep, 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 beep. We got some breaking news. Before we announce the sponsors, you said that you got some numbers from this like freezing temperature.
Oh yeah.
And everything that happened. Give us an update on kind of like how we
Yeah,
over there.
it got real cold here in Jacksonville a couple of weeks ago, into the 20s. And I always I used to think of like fun and exciting weather a different way when we used to have like hurricanes back in college. There were like hurricane parties and things like that. Very different tone now when we have some weather events here as we manage 5,700 homes. So as the cold weather rolled in, we were prepared, making sure that our residents were prepared for the cold weather. And, we were concerned about things like frozen pipes, because the pipes here in Florida aren't acclimated for that. So I wanted to give you some insight into that.
And the population is not exactly acclimated for it, right?
Very
Like
good
we're
point.
not used to seeing that. I
Very
made
good
that
point.
mistake.
Very good point.
Yeah.
None of us were acclimated to it. But I wanted to give you some real numbers. We had 76 emergency work orders that came in the days coming after the drop in temperatures. So most of them, I would assume, were plumbing related. So 76 in comparison, that's a pretty healthy amount. In past storms, I've been able to share the number of work orders, and this isn't to the level of like a major storm or passing or hurricane, which we haven't had a major hurricane in a while, but 76, that's a busy day. Yep. And we had 76 work orders. I'm happy to report 73 out of 76 work orders were solved by Friday of that week. Solved, completed, closed, resident is taken care of. There's only 3 open work orders. And again, we manage over 5,700 homes here. So by and large, we did get a spike of emergency work orders. That's why you rely on us. We're built for this. We're here to serve our residents and to serve you. And it worked out very, very well, all things considered, overall. So I wanted to share that.
And that would have been Sunday. That would have been on Sunday, right? Like the freeze happened on Sunday. So
the really funny thing is it's the day before we moved into our new office. And so the question was, this is a 100-year-old building that we have that we just renovated. The question was, are we going to have frozen pipes bursting the day that we move into the office? Luckily for JWB, we did not. But our neighbors in a neighboring building actually had that happen. So it was the day before we moved in, which was 2 weeks ago.
Interesting. So I happen to know that the industry average of maintenance work order, turnaround is about 6.7 days.
Oh, really?
And if you guys had 73, how many are still left over?
There's only 3 emergency work orders that are still being worked on.
So definitely crushing that industry average.
Oh, yeah.
Like definitely under 6.7 days.
Oh, yeah.
I assume whatever the 3 were special scenarios.
Special scenarios. Yeah. You got to make sure that you take care of those scenarios. But yeah, those and these weren't just regular work orders. I would imagine your industry average is regular work orders. These were emergency, like must be taken care of work orders. And those were solved much, much quicker than 6 days.
Love it. Love it. Very well done, buddy. We got a couple more people checking in. We got Monica Cardenas, who is checking in for the first time in Zoom. Monica, welcome to the show from Murrieta, California.
Wonderful, wonderful. So nice to have you.
Yeah, good to have you. We have Hervé Francois in the house.
Hervé, good to see you.
Hervé, always good to see you.
We're going to miss you at Summit, buddy.
Gonna miss you at Summit, buddy. But still expect us to take karaoke to the next level.
You know it.
You know that's going to be a guarantee. And somebody else checked in here that I missed. I'm sorry I missed you if you checked in here a little bit late. All right. That being said, we've got a couple of sponsors to announce. We want to thank our Not Your Average Investor Summit sponsors. We got a couple more to announce here.
We do. We have 2 special sponsors I wanted to shine a light on and say thank you for sponsoring and give a little bit of insight so that everybody here who is coming to Summit is just that much more fired up. Guys, the sponsors we have are top notch. So the first one I'm going to recognize here today is Julia McKillop of the McKillop Law Firm. Julia and her family, the McKillop Law Firm, are family to JWB. They actually built the McKillop Law Firm right here in JWB's offices. So another success story of this wonderful kind of incubator that we all are a part of here. And the McKillop Law Firm has served, I would imagine, almost probably everybody on this call has worked with the McKillop Law Firm in one way, shape, or form. Julia heads up estate planning, probate, asset protection, trust administration. So she's going to be sitting on stage with us, being that resource for all of you for any of those types of questions here at Summit. Her firm has closed over 11,000 real estate transactions in the last 5 years. She is a wonderful resource for legal planning, estate planning, asset protection. She does my own personal asset protection. So we are so pumped to have Julia on stage with us and sponsoring the McKillop Law Firm. Just an incredible partner. So hopefully, you guys, if you don't know the McKillop Law Firm yet, you are going to know what a wonderful resource they are for you at Summit.
McKillop Law Firm, also founded in this office where the studio lies,
exactly.
right? GC was telling me that. I was like, what? Did we say that about everybody?
It's the incubator right here.
The incubator. And then they moved across the street over here
right there.
In another building. So right across the street. Julia McKillop did me a solid not too long ago, right? Like I was traveling out of the country. I don't know if everybody knows this. I'm Venezuelan. At a certain point, there was like a real uncertainty around immigration and being able to get back in the country.
Yeah.
And because of that, I had to like set up like powers of attorney in like a drop of a hat with my wife. Was able to do that thanks to Julia McKillop. Always very, very happy to help and with a smile and turns things around quickly, easy to trust. We love the McKillop Law Firm.
We do.
All right. Who is the other sponsor here? Well, not the other sponsor. Give me the sponsor, GC.
I'll give you the next sponsor in line. So we've got James Moore and Company, just an incredible CPA firm that you guys are going to love meeting. Many of you have already met Daniel Recanti, who is friend of ours, friend of the show. Daniel has been on the show in the past and just a great guy. Daniel and I have built a nice friendship. And James Moore is just this wonderful company that we have been working with for a number of years. They are there to support not just your typical CPA, not just your run-of-the-mill, like, taxes and all that other stuff, talking about full support, the entire life cycle, there to understand and support from a CPA perspective, entity structuring, cost segregation studies, which we get a lot of questions about, 1031 exchanges, all of this really fun and exciting stuff that we get to sprinkle into your JWB portfolio. James Moore and Company is here to serve you. So they're going to be there at Summit as well as a sponsor. You guys are going to get to know them. And guys, they have been here, founded in Florida since 1964, manage over experience working with over $1 billion in real estate assets. So definitely a team you can trust and are going to be excited to know. And we're super thankful for their sponsorship.
Yeah, Daniel Recanti, great guest on the show. Came in the studio.
Yeah.
Right? Yeah.
Oh, yeah.
Sat down with us, spitting hot fire. Guys knows
he's a hell of a pickleball player too. I met him on the pickleball court.
Pickleball court.
Yeah. Oh,
pickleball
yeah.
player.
Yeah, that's what I'm saying. I know you hold those guys in high esteem. So just wait till you see Daniel on the pickleball court.
A measuring stick against you is like something to consider. You're just different levels here. Awesome. So we are super pumped to have James Moore and Company. Is Daniel's going to be there?
Yep, absolutely.
Awesome, man. He's a super great resource. And now onto the topic du jour, Greg. That's what we call the topic of the day. This is going to be an interesting one, right? So again, inspired by Saran with a Plan show.
Mm-hmm.
Greg, in his Excel Genius World Championship quest to like make it to the big stage in Vegas, he was like, man, one of the things that you saw on that show, on Saran's show, is the ability for Saran to like understand where she was with her plan, hence the name, Saran with a Plan.
Mm-hmm.
And if we can visualize exactly where someone is when they're in this moment that they have enough equity in homes that they could possibly harvest and grow a property baby, then we can really paint the picture for people to make the move. Because one of the things that we uncovered on that show is like, or at least what I was going through is, it's kind of like when you're at the moment when you have enough equity in your homes, it's probably been a while that you've owned it. You're probably in like a really good cash flow position. And there's a bit of fear of going back on that cash flow. So the key is understanding where you are in that plan, understanding kind of like how that cash flow will be affected. Oftentimes it's not as bad as you think.
Mm-hmm.
And then seeing how much better you're going to be by doing this move. So GC over here put together a way to visualize this, and not ready to be tinkered with live, but we have some screenshots from it. You're going to walk me through it, right, GC?
Oh yeah. Well, it is live. My team is ready to rock with it.
Not live for
just
me to
not
with it
here.
A
little bit too maybe we'll get there one day. But this has been something, guys. I've been in the lab for about a year. Really coming from our conversations on the show, so many folks are in a position where they are sitting on a ton of equity, and they're also in a position where their goals are high, right? Their goals are high. What they're doing right now is they're sitting on this equity and they're saying, I want to be at this $10,000 a month in 5 years, 10 years, 15 years, or 15,000, whatever that is. And when I see a goal like that, and I see that right now the number of assets they have is this, and they're sitting on a pile of equity here, that's opportunity for us to literally take the equity that's in one hand, redeploy it in a whole other property or 2 or 3 property babies, and get you to your goal that much quicker. So with my team, we went in the lab about a year ago and started to think, how could we bring a tool together to help our clients be able to see that? And so super excited to share that with you today as a little bit of an appetizer. And then all of you, of course, will have the opportunity as JWB clients to get you around.
Okay, so let's do it. So do you see, we are wrapping this. We're kind of taking that format of a client success story here, in order to show kind of like where the portfolio is, how it's grown, and how we make these decisions. And this is all real-time stuff. Greg barely showed this to me right before the show, so I'm in the middle of making this consideration myself. He promised not to like hard sell me out here. I just told him to be honest, just to let me know what I got going on, and I'll make my own decision. Right. So that being said, somebody did ask in the chat, when is the summit? February 19th to 21st, 2026. Sold out.
It is sold out.
It is sold out. So unfortunately, it's your first time finding out about the summit, clients only. But we will be doing it again next year. This is our 5th one, so we will be back for the 6th one. And this, why don't you do the disclaimer here? My train of thought.
Yeah, everybody should do your own due diligence. We're going to be going through Pablo's numbers here. Pablo's numbers does not mean that it's going to be your numbers, or that you should take these numbers as a guarantee. Pablo and I, we are not financial advisors. This is not financial planning advice. This is helping you take your portfolio and maximizing it. But please do your own due diligence. And with that, take us away, Pops.
I couldn't have done that better myself.
Yeah.
Good job, buddy.
There we go.
Buddy. All right. So what do you got? What do you got to sell me, Greg? What am I gonna do to sell me a property?
What am I gonna do to make sure you walk out with a car today? Oh man. Yeah, so let's I thought we would do this in the vein of our client journeys that we have done over and over, and take people down that path to see how it has worked out for you, the pros, the cons. I think it'd be great for you to sprinkle in your insight and maybe some of the great things and some of the pain points. And then we'll take it to the next level, which will be, this passive income planning tool that we'll share.
Got it. So these are the 3 properties that I acquired in 2021 and 2022. First one, all of these are 20% down, I believe, that I acquired. So like highly leveraged. Had some money around for the first one. Second one, I bought Peloton right before the pandemic, and I cashed it out exactly 1 year after the pandemic, and it was enough to buy me a house, which is really, really awesome. And then the last one I remember going through, I cashed out an old IRA that I had, because at that point I just wanted to get my 3rd property I wanted to get in. I took a tax penalty there, but I was confident in putting this there instead of just like having it in the market at the time. Brought me to 3 homes, and this looks pretty good.
I don't have to do the hard sales pitch at this point, right?
Yeah.
You've generated over 160 grand in profits from those 3 great decisions that you made, and you've done this in less than 5 years. And the way that we have done this is a very, very similar model for all of the clients that are watching right now, right? We talk about how this model just works when you buy and you hold, and it has worked for you. Year over year, your money has turned at a rate of about 15% per year. Very awesome. Over $162,000 in total profits. And the way that we've gotten there is very, very predictable, right? Home price appreciation is the biggest driver of the profit pie, right? We're going to take a look at that in just a second, but $132,000 of home price appreciation by investing with the right team in the right market, where we put you in the right neighborhoods to be able to enjoy that. But it's not only that. You've had almost $29,000 of your loans paid down by your residents. And we love our residents. We treat them like gold. We want to invest in those relationships. And one of the byproducts of having wonderful resident relationships is that they pay your loan down for you. It's this beautiful profit center that not enough people know about. But that's not the only one, right? You have tax savings, right? You have these wonderful tax write-offs that you get in owning rental real estate. And that's added up to almost 5 grand for you. And then you've got net rental income. And here, I'll turn it over to you to talk about net rental income here. I I think it'd be great for you to share kind of your thoughts on net rental income, kind of what we were talking about right before the show.
Yeah, I was surprised I was negative. Lee said it in the chat, right? I had an eviction, right? Like I had during like the back end of COVID, went through a tough scenario there, where we had to go through an eviction, and then a turn afterwards, and then it was sat on the market for a little while longer than I expected, right? So, those are really, really intense moments. Now that we sit here, that was probably, man, late 2022, I would guess. And it seems like a distant memory, right? So like after that, we've been in this like really, really good scenario where we haven't had vacancy, people have renewed, got a big, like a big increase in my Katina property, which was like a 4.2. And I sit here with like really positive cash flow and like to be honest, a whole bunch of cash in my savings account that I have for my properties because it's continued to grow since then. So I was honestly shocked that I was at negative total because it was just like a very compressed amount of time where I felt that. And then since then, it's felt really good. So I thought that I had made it back and more. I also want to clarify something. So I talk about having 5 doors. One of them is a duplex that I'm like house hacking, and that's not included in this because that's a separate thing.
Yes.
But yeah, like that was a really tough moment, man. Like the going through the eviction and feeling there, was one of those moments. I remember thinking, like what the community tells me, hey, there is, like this is just something that happens every once in a while, and you will have other moments of prosperity. And I held on to that, and I've been in a moment of prosperity now for like 3 years where I haven't really had any of those headaches or anything like that. And like I said, I feel like I have really good positive cash flow right now.
And you do. Yeah. You do. So a couple things just kind of like I can relate to and I see over and over and over with other clients from what you just talked about there. Whether we're going through a period of prosperity or we're going through a period of a challenge, right? The feelings that we have there are very real. Yeah. And it's really hard for us to equate what has happened 3 years before or 3 years later.
Yeah, that makes sense.
You're just in the moment. Yeah. And sometimes they're painful moments, right? But just like you have been saying, hey man, I think I'm making like $500 a month in positive cash flow. And I feel like I've been doing that for a number of years, right? Well, it's good to be able to have the lifetime reporting here, which is what we have, but also know, and I see the other side too, right? I see clients that have earned tens, hundreds of thousands of dollars in positive cash flow. And we have a moment, right? A challenging moment, an eviction or whatnot. And we get upset, right? And we go back to this report and we say, listen, this is a moment in time. These moments happen. It's a part of rental real estate investing. Let's look over the long haul here for net rental income. And let's look even bigger here beyond all the profit centers. And so you had that same opportunity. The other thing that kind of rings true for me is like, you know what, the value of this community for you, I think is just showing its colors here because, you wouldn't have done what you did to buy your first one if it wasn't for the community.
For sure.
You definitely wouldn't have done your second one because that was more of an advanced move to sell stock, to go and put it into your next rental property, right? To move the money from one asset class to another. Yeah. Not everybody does that. So that's an advanced move. The third property was a really advanced strategy. Yeah. You weighed the pros and the cons, and you took a penalty on your taxes to be able to find the money to be able to buy your third property. And it has worked out very, very well for you. And then the fourth thing is that when we stub our toe a little bit and we have an eviction early on, many real estate investors say, you know what, I'm out, or I can't handle this or whatnot. At all 4 of those junctions, this community really supported you. And now you're here 5 years later looking at these types of profits, man.
I love it. I love the 14.5%. I feel like, if I'm not wrong, my performance said like 12%.
Yeah, something like that.
Or maybe less. Yeah. Right? It was like 11 to 12%. So love to see that I'm overperforming right now.
Yep. We do too, buddy. We do too. It's not surprising how we got there. We talk on this show about the Pac-Man principle. You love the Pac-Man principle. Why don't you share the Pac-Man principle? You did. It's your Pac-Man principle.
When you look at the 5 profit centers in rental property investing, there's cash flow, tax savings, debt pay down, home price appreciation, and inflation hedging. But when you lay them out on a pie chart to see which ones amount the most of your growth, right? Like per kind of like percentage of return, you notice that they're not all equal. Home price appreciation ends up being somewhere between, we say, 60 to like 80% of home price appreciation. And in my case, it's a big one, right? So when you look at it, this blue one right here, Greg, this one's blue.
Gotcha.
Yeah, yeah.
Love that.
Yeah. This big one, it always looks like the Pac-Man, and everything else is the mouth of the Pac-Man when you put it on a pie chart. And I got a Pac-Man with not a very wide open mouth. I got a whole bunch of home price appreciation.
It's a beautiful thing, right? And this is why, if we understand that home price appreciation is the biggest driver of wealth, we have to pay attention to the team, because the team supporting this is the only thing that's going to allow you to stay in the game long enough to be able to experience home price appreciation. And we have to focus on the right market, and we have to focus on those markets where there's population growth. Population growth drives additional home price appreciation. And did both of those things, and you're sitting here and your Pac-Man principle is playing out for you, just like it does for every single client journey that we do here on the show.
Love it. Love to spend Pac-Man. So 81%. So I'm an outlier.
You're an outlier. Well, you did buy at the exact right time.
Yeah.
For home price appreciation.
Yeah.
So over time, that will get to be between 60 to 80%.
I would also assume that if I hadn't had that eviction early and I had more cash flow, then that would have also probably put me on.
You'll be right to 60 to 80%.
It's good to know that home price appreciation saved the day.
Yep.
All right, cool. So what is this, GC? This is new to me.
So this is the next step in our client journeys. Maybe we'll start doing this for other clients as well, but this is the next step. You know, what we started to do was to say, all right, that profitability snapshot that we just shared for Pablo is wonderful, but if we are really here to help people and to financially engineer a better outcome for them, or a more quicker financial outcome for them, or a bigger financial outcome for them, well, that type of reporting is incomplete, because it doesn't take into account your total financial portfolio, and it doesn't help us see how easy would it be for us to harvest equity over here and redeploy it over here. It's more of what we just looked at as just a profitability snapshot. But when I'm sitting down and I'm thinking, oh my gosh, let me understand what the goal is for this client, and let me understand the pile of equity that they're sitting on, the money that's just doing nothing, it's really just dormant for them. Well, I need to look at a different picture. And so now this passive income planning tool that we'll be sharing with all of you at Summit, all of our clients have the ability to use this tool when you sit down with JWB clients. We look at it from a different perspective. And so that's what we're going to go into now. It first starts by just truly getting a snapshot of your portfolio at this moment. Mm-hmm. And so here's where we start the conversation understanding what your goals are and what your timeline is. So we talked before the show, and you shared that your passive monthly income goal is $10,000 a month. Mm-hmm. That's what you would like to have coming in from your portfolio. And you shared that you want to achieve that goal in 15 years. Can you give everybody some insight onto why that goal matters and why that timeline matters for you?
Yeah, I think that $10,000 a month is I feel like it's almost like a trope, right? Doesn't everybody have that?
It is very common, very common. Yes.
Right. Like man, if that is my floor of my income, then I feel really, really comfortable. Yeah. You know, like at the end of the day, I think like we talk about this idea that's like after $75,000 a year, like every extra dollar you make marginally doesn't really add to happiness.
Yeah.
I think somewhere around 120, you're, living in a city like Jacksonville, you afford a pretty good life.
Yeah.
If I can get there just through my real estate portfolio, then I have a lot of options, man.
Optionality, ownership of your time, right? Yeah. The ability to make decisions for the right reasons, whether that's your job or how you spend your time, all that becomes possible when you start to achieve something like $10,000 a month. The cool thing to keep in mind is that this is inflation protected, it's inflation hedged as well. So the $10,000 a month that you're hoping to earn right now will, the income continues to go up because it's hedged against inflation. So you can think about the dollars today that you'll need in 15 years as well. And so those dollars will continue to go up over time. But this is just the layout right now. So I'm going to take you down this journey. On the left side, whatever color that is, that's our current status for Pablo and his portfolio. And then on the right side, what color is that on the right side?
It's like gray and light blue. So it's not a very big difference in color. What do you see? Like different shades?
Yeah, I see some sort of different shades a little bit. I don't know. I couldn't tell you what it was.
It's not gonna be the color black.
But what we'll see on the right-hand side is that this is what our new plan can be, and we'll round out our conversation by showing you what Pablo's new plan can be as he goes and he starts to consider this.
Got it. Do we go to the next one?
Well, let's just stay here for a second. Okay. So we've got 3 properties right now. We need to hone in on something, right? We need to hone in on what is our acquisitions goal. So just like Saran, who did a wonderful job sharing Saran with the plan, right? She talked about she's in acquisitions phase, right? There's 3 phases here. We've got acquisitions phase when it comes to your rental property portfolio. Then we've got the strategic debt paydown phase. And then we've got the distribution phase. And distribution is the fun part, right? I think they're all fun. Saran thinks they're all fun, I could tell. But the fun part as far as the portfolio kicking off this passive monthly income for you and accomplishing those goals, that's the distribution phase. We're going to get you there, but we can't get to step 3 until we take care of step 2. And before we get to step 2, we have to take care of step 1. We have to have the right number of assets in your portfolio if you want to achieve a passive monthly income goal of $10,000 a month in 15 years. So this acquisitions phase is super important, and flat out right now, there's a lot of folks that are sitting on the sidelines with a lot of equity just sitting around, and they're not to their acquisitions phase completion yet. So this tool now helps us see this. For you, in your case, when we look at what the cash flows are going to be, we're at a 43% mark for your acquisitions phase, and we got to get it to 100%. And we can get it to 100% in a couple of different ways. Well, you can make more money, right? You can bring more cash to the table to buy, which is the way you did it in the first place. Or we can look at the money that you've already built up from your portfolio. Or the less fun way to do it is we have to drop the goals. Right? We have to have a conversation with you, Pablo, and say, listen, I just don't see this as possible if we're not going to redeploy the capital, or we're not going to bring more money to the table. Or we have to take the target years out longer than 15. Right? And maybe this is a 25-year plan for you, which may be great, you know, but our job is to give you that insight today. And then, you know, if that means that we need to change the goals, we will. But what we don't want to do is to have us going down fairy tale land thinking that we're going to get to this goal at the current level of assets that we have in the portfolio. And this helps us see that. Okay, love it. You've got your current monthly passive income of $366 a month. That's what's happening right now for you. So when you were saying, you know, I feel like I'm earning, you know, $400 or $500 a month passive income, you really are. You're close to there, right? And then look at your equity, man. So the equity number, 270,000, is different than the profitability number of 160,000, right? Yeah. And when I was sharing this with you before, it was kind of an aha moment for me, right?
Yeah. Because I think, you know, we've seen all these different like client reports. You see this like home price appreciation profitability. You forget that, oh yeah, I put 20% down on all of these. That's equity.
Exactly.
Right. So like the idea that like I get to tap into these profits, but I also get to tap into that money that I had already put into there is really, really attractive.
Exactly.
So I have an extra like $100,000 essentially of money that I had already brought to the table that I can now double dip into.
Exactly. Cool. Exactly. And so for us to do our job as financial engineers, we have to see the complete picture. And that's what this tool now provides for us. And look at this, like, and just to accomplish and do what you have done right now, look at what you did for your family, right? 5 years ago, you made 3 decisions and you've built up $270,000 in equity and an income stream of about $400 a month. Something certainly to be proud of, man.
Cool. And if I get one more, then I'm more than halfway there.
Yeah.
So the thing I'm thinking about, I'm at 43% here. That's cool.
Yep.
All right.
And here's what it looks like.
Real quick, Gerard Wendling asked, this $10,000, is that gross or net?
Net.
Yeah.
Net. Yep. Fun to think about what 15 years will look like. So our passive income planning tool allows you to do that. If we do nothing, if for Pablo's portfolio 15 years from now, his monthly passive income will be about $2,300 a month, which is really wonderful. When we talk about how this asset class is so great, it's like a fine wine. It gets better and better with time. You're seeing that exemplified right there. And then, oh my gosh, right? Look at the fact that from an equity perspective, if you do nothing different, you just hold on to this asset and it continues to perform like it typically does, you're going to be in a position of $1 million equity position in your portfolio.
Great.
really awesome. From the decisions that you made, and they weren't easy decisions 5 years ago.
Yeah.
But from the decisions that you made, and then the community support, and you making the good decision to continue to, of course, be a part of this plan, this is where it leads you. And that's why we get through some of those tougher moments like evictions. It's because this is what's on the other side.
Yep, that's good stuff. I like to see when I become a millionaire. That's cool.
There you go. There you go. All right, so that's the big picture. We got the current plan, or we got the current state, and we're going to see what we're going to do with this current plan and see if we can get closer and closer to that acquisitions goal being, 100%. So the first thing we have to do is let's see how much money it would take for us to make a what, Pablo?
Property baby.
You know what? You just said it. I thought you were gonna do like, what did you do last show? You did like some movement or something.
I said I was property pregnant.
Property
I was
pregnant.
gonna deliver a property baby.
Well, it's because you are property pregnant and you are looking to see what it will take to deliver a property baby. This is going to help you do that. Okay. Of course, this is
feel those kicks. He's getting
there you go.
Okay, continue. Yeah.
Oh man. So this is what we're showing you are snapshots here. This is a fully interactive tool. So my team can sit down with Pablo and say, all right, this is what it would take. And if we wanted to add to, what would it take and all this good stuff. But I wanted just to give you a snapshot. And what you're going to find is that for a typical JWB turnkey property today, it's going to take somewhere around $60,000 to $75,000 on average. And that's including your down payment plus your closing cost and things of that nature. So in order to make a property baby in your own portfolio, we got to find somewhere around $60,000 to maybe $75,000. Okay.
So I'm looking for $75,000 in my couches.
There you go.
Okay.
There you go.
Real quick, Vinny Valsamac is asking that when Greg says passive income, that is after all expenses, right? So mortgage, taxes, property management fees, all that good stuff.
Yes.
And that's a yes. Hervé is asking that's monthly passive income, right? In the next 15 years, monthly in my, right? So
yes.
this would be my monthly passive income net.
Yes.
All right, cool. That's
yes.
awesome. I love that.
Yep.
Okay. So we're looking for 60 to 75K.
Yes, we are. Yes, we are. So let's go to the next one. So now we know we've got to find 60 to 75K if we want to take a step forward to that passive or to that acquisitions phase. And then I think it's really cool for us to see, what does that decision do for us? What does this property baby do for us in 15 years?
What's this baby going to do?
So just like it's been an aha moment, I think, for you going through this now that you're 5 years into it, as far as your monthly passive income and your equity, well, let's future state this for this next good decision that you may make. And so we can look at it from a current monthly passive income perspective. In essence, you would be taking equity over here, harvesting it, redeploying it because you're buying cash flow, right? And you're buying growth, right? For a new asset. Well, it's going to kick off a couple $100 a month now. In years, 15 years from today, that'll be $360 a month, which is kind of similar to kind of like what you have seen happen for your entire portfolio, right? You had 3 properties that are kicking off roughly $400. Well, that same type of getting better and better with time will happen with this property.
That is, so if in 15 years I'm going from 230 to 362, it's almost like a 50% increase, right? Like what's the delta? That's like 130. It's more than 50%. Okay. Yeah. I'm just trying to do the math here. All right, cool. That's interesting.
Yeah.
So in 15 years, it goes up 50%.
Well, yeah, there's a lot that goes into it. So, not only is your income going up, all of your expenses, not all of your expenses, all of your expenses except your mortgage payment are going up. And then there's incentives that come into play for your monthly passive income today that will burn off over time as well. So there's a lot that goes into that number, but this gives you a really good picture of what it will look like. And then the equity position, like,
the equity is sick,
right?
$155,000 more equity.
Yeah,
that's wild.
You got more monthly cash flow and another 350 grand. And just think about it, right? Let's say that we have that, call it 60 grand, that's just sitting in equity doing nothing for you right now. You're taking that 60, literally redeploying it, and now it's 350 in 15 years, right? Yeah. Really cool, right? Yeah. Really cool. So that's what your property baby can do for you in 15 years.
Just that property.
Just one property. Exactly. So now let's go find the money. Okay. And again, all of this is an interactive tool. We can walk you through that. But for here, we're just going to take these snapshots. One of the things we do is it's really easy for us to pull in all of this information to make it easy for you to see what your current properties have as far as equity and how much you could pull out if you were to do a cash out refinance. So what this allows you to do is to look at it. And I assume that there's a refinance loan interest rate of 6% here, fully adjustable as rates go up or down or whatnot. We can adjust that. But if we were to refinance all three of your properties today, what we would pull out is that column there, right? About $19,000 on Minosa, about $25,000 on Lucky, and look at Katina, about $63,000 on Katina. Really cool. But we can't just get excited about the amount of equity and cash that we could pull out to redeploy. We also have to keep our eyes on what does that do for the cash flow position of the entire portfolio. Because if we max out our cash out refi, we might be cash flow negative in that property. We might be cash flow positive in that property. And that may be okay. We just have to understand it before we actually go forward with the plan. So if we were to max out our refinance for all three of the properties, you can see how much money we'd pull out there, like I just mentioned. And then what you're able to see is what would your monthly passive income be based on a yes or a no decision of whether or not we're going to refinance. And I highlighted Katina here because of two reasons. When we're looking at the right amount for us to refinance and equity harvest for our clients, we're looking at how much can we pull out. So we're looking for a big number because if we're going to go through the cost and the work to refinance a property, we want to make sure that there's a healthy amount of equity in there. And we also want to see what does that cash flow position look like. But what we need to keep in mind here is that we need to keep that portfolio mindset, right? I highlighted the cash flow position on Katina of negative 487% or negative $487 a month. We believe in positive cash flow. We believe in positive cash flow from a portfolio perspective. So just like we were talking about on the previous slide of a property baby, what can it do for you? You're buying the cash flow. You're buying a couple $100 a month of cash flow. That will offset potentially a negative cash flow situation that you may want to do for a property that you equity.
And this to me is the biggest murky fear kind of that I have, right? Like it's like this was the moment on the call with Saran where I was like, oh, wait a minute. So you had to kind of like talk through this with your husband of like, you're going to take a step back in cash flow and what does that look like, right? So to me, this is exactly what I want to see in this report.
Exactly. And in order for us to be good financial engineers and a good partner to you, we have to see all of the picture. And so in that vein, we're gonna dig a little bit deeper and we're gonna show you this too when we're analyzing it for you. So you can go to the next slide here. Then so we sort of like looked at what was the max equity harvest we can do. Now we need to ask ourselves, which assets should we equity harvest and do the cash out refinance on? So all this information is available as well at the touch of at the click here. So we're able to see all of the properties and the debt information. And I highlighted the original loan interest rate because we have the ability to make really good decisions on an individual property refinance level, right? Two of your properties have extremely low interest rates, 3.6% on Minosa, 4% interest on Lucky.
I got in when the getting was good back then.
Exactly. Exactly. Now, it still may be a good idea financially to actually refinance if you have a very low interest rate. It could be, right? Happy to walk through the numbers. But if that's the case, we want the equity pullout, right? The amount of harvesting that we can do to be large, right? If we're going to trade a lower interest rate for a higher interest rate, it's got to be justified. The numbers won't make sense unless it's a large equity position. And if we can avoid having to give up that low interest rate, we certainly want to, right? So now we look at it and we look at a couple other things too. How long has the loan been in place, right? What's the current loan balance? Those are things as well that we look at and say, okay, well, this is a good idea to harvest the equity on this one and do a cash out refinance or not. But for here, we have a clear winner because your interest rate on Katina is 5.75%. Right? Your interest rate for a cash out refinance is going to be somewhere around 6% right now. But we can pull out over $60,000 on Katina. So it lines up very, very well for us to take that step forward to be able to have a property baby and to not trade a really low interest rate for a much higher interest rate on Katina. And the same can be said on Minosa and Lucky, meaning that like it makes a lot of sense not to refinance those. If we want to go to the next slide, I'll show you how the numbers work out. We can harvest over 60 grand in equity just from the Katina property here at the bottom. But we're going to decide not to do Minosa and Lucky because we were only able to pull out like $20,000 on each of those. And that wasn't going to get you to your next property level anyways.
Yeah.
Right?
So
and
keep the debt in place.
Keep the debt in place.
Yeah.
So now that we keep the debt in place here, and this is the cool part, this is where I nerded out on all the Excel for it, right? Like now at the click of a button, we can say, all right, well, let's keep the existing debt in place for those two. What happens to the monthly passive income there? And you can see now it's a couple $100 a month for each of those properties, which will offset the negative cash flow position that we're in Katina, and only adds to the overall positive cash flow that we have in your portfolio as we potentially add another property.
Got it. So this is right now this is like the plus and minus of cash flow in my existing portfolio right now. If I was to refinance, we have not yet added another property that will bring in more cash flow. But what I can see is, like, I don't know, let's say I just needed 60 grand for something.
Right.
And I pulled that out, I would essentially just go back to like break even cash flow on my portfolio, and I'd still be able to take this $63,000 out and do whatever.
Exactly. Think about it this way. When you bought these properties, like, I don't know, maybe it was $100 a month of cash flow or something. It was largely break even plus a little bit, right? You can largely get right back to that same place.
Yeah.
Plus pull out $60,000 for the portfolio if that was the right thing for you guys to do. So just a win overall for the decisions that you made back in the day.
It's pretty good. All right, we'll answer your question, Alex Diaz, in a little while.
So then that all comes back to this. It comes back to your passive income plan. Again, on the left, we've got currently where we're at, and on the right is the new proposed plan. And on the right, we now can get to 4 properties without any cash out of pocket for you. By doing that, we are taking a step towards our acquisitions phase. You'd be all over halfway done for your acquisitions phase just by taking it from the left hand, putting it into the right hand, and putting it in motion for you. What are you giving up? Well, you're giving up a little bit of that monthly passive income today. So here's where the conversation is, hey, Pablo, you and Martha, do you need $366 a month of passive income, right? Are you living on this income, right? It may not be the right move for you to do this if you need that amount of income per month, right? But it also may be the right move if you don't need all of that income per month, because we've seen what it does for you in 15 years by doing this. So if you were to decide, hey, listen, I don't need all that income. I want some passive income each month. It's going to help. It's going to make this, I don't want to get close to break even, right? But I don't need $400 a month. Well, then we can talk about the decision being adding that next property, which would leave you with an estimated $230 a month of passive income for your entire portfolio.
So I don't go down to break even. I just go down to $228 from 366, right? I'm essentially just losing like $138 a month in passive income.
Exactly.
Which isn't really going to materially change my life, but I would add another property. I'd get beyond 56% of the way to my goal. And then I would be adding all that extra equity, 300K in equity in the next 15 years as well.
Exactly.
It's a compelling case.
Pretty good trade, right?
Yeah, pretty good trade.
And then we take a look at our equity position. Now, we have given up some of our equity to do this simply because there's costs that come along with refinancing and buying properties as well. So our equity position we still have over a $250,000 in equity. So something really to be proud of here. And then we can take a look at what this does for us in 15 years. The good decisions that you made 5 years ago, you're seeing the fruits of that labor today. Just imagine how much better it'll look in 15 years. And through the tool, we're able to give some actual numbers to what that means. So 15 years from today, if we go forward with just harvesting the equity, redeploying it, adding that 4th property, you're going to be at roughly $2,300 a month of passive monthly income with that portfolio. And your total equity position 15 years from today will be over $300,000 higher because of redeploying the equity that's just sitting there dormant for you.
It's really interesting that I kind of end up in the same exact cash flow position, just with a $300,000 more in my pocket.
Yeah, exactly.
Yeah, that's interesting.
Exactly. It's because you've got 4 assets now that are working for you.
Yeah.
Right. We took the equity over here and now it's got 4 assets that are growing.
Yeah.
And so for 15 years, your cash flow is growing on that 4th asset.
Yeah. There's a conversation going on here in the chat that I think I want to hit on. The first one is, so can I, for that 63K, that's enough to buy a JWB property, including closing costs right now?
Yeah.
Okay.
Yeah. On average, you'll see it's about 73K, but that's for a $235,000 property. If my numbers are, if I'm saying that right from memory. When a client comes to us and that amount that they have that they can equity harvest is $60,000, we can make sure that we look at the inventory and choose a lower priced property. A lower priced property will be generally a smaller home. Yeah. Very similar to the homes that you bought early on, right? We bought smaller homes because we were working with a limited budget at that time. So anywhere around 60,000 is something that we can work with. As you get below that, it's probably not realistic based on current market conditions.
Yeah. Or I can bring extra cash to the table.
That's a great point. Yeah.
Right. Also.
Right.
That's interesting, man, because the small versus big home thing. I remember when I was buying Katina and I was considering another smaller price home, smaller price home versus Katina. And I remember being like, no, I want to buy, like this is my last kind of like bite at this apple for a little while. So I wanted to shift as much capital as I could into this bucket for right now. And that was my only thinking around it. It's super interesting to look back now and think, all right, these other homes had 6 months, a year more of home price appreciation. And I bought them when the market was even lower, right?
Yeah.
But because Katina has such a big price, that is where the majority of my home price appreciation equity has come from.
Yeah.
Right. So it's like it's the same, it's been the same market rate of appreciation, but because it was from a bigger number, I have way more appreciation total, way more equity total. And it makes me completely rethink the idea of like, do I want to go small properties versus big properties when it feels like the bigger the property, the faster the home price appreciation pie grows just based on it's just a bigger chunk at a time.
Yes, and so yes, you will see bigger equity spreads, bigger appreciation numbers when you invest in a larger property, but it took more of your capital to get there, right? Yeah. So keep that in mind, right? For Katina versus the other 2 properties as well, we just experienced more home price appreciation in the Arlington neighborhood. That's in the time that you bought, we just happened to experience more home price appreciation there than we did for the other 2 properties. However, remember that report that show that we did on the 21 fastest growing neighborhoods?
Yeah,
from Zillow
is in there.
Yeah. The 9 fastest growing neighborhoods, 9 of the 21 fastest home and growing. Let me start over. 9 of the 21 fastest growing neighborhoods in the state of Florida were in Jacksonville, and they were all around your properties on Lucky and Minosa. Yeah. And what they looked at were the 10 previous years. And so if you had bought those properties at that time, it would be a very different story as far as how much appreciation you would have received for the dollars that you put into it. And so what we know to be true is that workforce housing is the place that you want to be in from both a cash flow perspective and from a growth perspective. We don't know if Arlington over the next 5 years is going to have more appreciation than the north side or the south side or the west side. And really, it doesn't matter over the short run. Over a 5, 10, 15, 20-year hold, you're going to find that it's all going to sort of even out. So yes, when you have a bigger property, you are going to see, generally speaking, more home price appreciation because the numbers are there. You had to put more in to get it, right? So don't lose sight of that. And then also there are differences when you look at very short windows of time as far as how much homes have appreciated for the market. But that's not a strategy. It's not that the next time, if you were to sit down with our team, we're going to say, hey, listen, we had more growth over the last 5 years in Arlington, so we're going to put you in Arlington because that's just not real. There is no data to support what is going to appreciate between workforce housing neighborhoods over the next 1 year, 3 years, 5 years. You just buy into the model. and then you'll get roughly the average appreciation that you would for the market over time.
Yeah, that makes sense. I just think of, right, like when I'm investing in stuff, I'm thinking of like where are my buckets that I'm investing in, right? Like as I've told you, I believe in this idea of putting 80% of kind of like into right like the 60/40 portfolio to me is more I see real estate as kind of like that like high floor asset. And I also see it as kind of like a high upside when I'm looking at a 14.5% rate of return that I'm getting. So, like I just see it as, all right, I want to do what I can to put the the bigger chunks as early as possible into it, knowing that and having lived this over the last 5 years, that gave me all that
it's
that equity.
It's changing the paradigm of how people think about investing in real estate. But if you think about how you invest in the stock market, you're like, hey, listen, I want to put this amount of capital into something. You don't think I want to buy this number of shares, right? I want to put this amount of capital because it's the right thing for me to do, right? You're looking at houses now and you're saying, I want to put this amount of capital to work in houses. And you're saying, well, that might lead me down the path of a higher priced home. And I see that. Whereas probably the average investor on the street, they would look at it and say, oh, you know what? I just want the cheapest one.
Yeah.
Right. So there's the difference. And you've kind of elevated to a higher level.
Yeah. Okay. Good explanation. You say all this stuff about like how it's because of the community that I've like done a lot of this stuff. And it's 100% true. It also is, I'm so indoctrinated in the way that we think that I never think of like how an average investor thinks.
Right.
I'm like lucky enough to have like come in unspoiled.
Yes. Yes. You were unspoiled.
By all that good stuff. Nadim is asking, so Pablo has to go up with, no, or he already asked that. He's saying, so what will that do to his passive income? Will it go into the negative? And I think what he was looking at was based on my current portfolio, yes, it would go into the negative if I do this cash out refi of Katina. But once I add the other property, I'm not going to go into the negative. I'm only going to go from $366 per month to $228 per month. Something that, what was it? Somebody, and then Pamela Myers is asking, are taxes, insurance, and property management fees factored into these numbers? Yes. This is all net.
Yes,
right?
Absolutely.
Who came up? Somebody made a really good breakdown here. Basically said, I'm basically giving up $100 a month for an extra 300K.
In 15 years.
In 15 years.
Yeah. And $100 a month, if you don't need it to live on, right? It's just dormant. It's just sitting there. That's the thing. You've got big goals out there. Your big goals require a certain number of assets in there, and you're sitting on a gold mine, not doing anything with it. We gotta mobilize that, right? If you just mobilize it, you'll get to a much higher percentage of your acquisitions phase, and then you'll get to your goal much quicker.
Oh, it was Billy Green that said, I'm giving up in 15 years. I will have given up $8 per month for an extra, for an extra 300K. Even better deal. I love that. There was a really good question from Alex Diaz earlier. Alex put, I have 3 JWB babies, but he took HELOCs on 6 properties versus cash out refi. What can Alex do to improve equity harvest since Alex did the cash out, the HELOC instead of the cash out refi?
Let's take a look at it, Alex. I think we love those conversations. So there's a lot there. And the fact that we've got the home equity lines of credit, it would depend on how much those are paid down now. What is your equity position still after those home equity lines of credit? But that is exactly the type of conversation that we love. So Alex, just reach out to your portfolio manager and our team can sit down with you and go through this exact type of planning tool with you. Now, I will say, I would imagine one of the questions that we will get often is, well, if I have taken out a home equity line of credit or if I've already refinanced, will the tool tell me that? No, the tool is not all knowing. It is the information that we had when you first purchased your homes. But that doesn't really matter. It shows a vision of what can be done. And then we can take the information that you give us about your current loan situation or like the home equity line of credit situation that Alex is presenting. And we can take that, use this tool, put it all together and get to a great conclusion for you.
I love that Hervé is in here in the chat claiming, hey, Andrew, I did the same thing. I was able to double size of my portfolio from 3 to 6 properties. Hervé was like the original
He
guy
was.
that we had on here to show this concept. It's amazing how far we've come from like Hervé's show, which was probably about like 4 years ago,
Yeah.
to now Saran's show and the ability to like develop the message and be able to like show this and like really think through it. I think is a cool full circle moment. Alex Diaz says, I'll be at Summit and we'll work with the new tool. Love that. Me
Awesome.
too. And then there was another comment here. Oh, yeah. So Brian McKay says, these properties still need insurance and property taxes accounted for. How do we get those two things to vanish?
Well, the good thing is that these properties already have your property taxes and your property insurance costs, along with property management fees, along with maintenance costs, vacancy cost expectations. Every cost has been built into these numbers. So it's already accounted for. The bigger question about how do you get property taxes and insurance to vanish? I don't know. Can't help you there.
Love it. Yeah. So you get it to vanish by just assuming that it's already in here and then take it out
There
the
you go.
spreadsheet, right?
There you go.
Yeah. That's awesome, GC. I've got I've got a decision to make here, right? Like I'm really looking forward to the summit to sit down with my portfolio manager at the summit, go through this thing. I'm trying really hard to get Marta to take that Friday off of work so she can
awesome.
like sit down and just really understand all this. But it seems like a great deal. Like I don't know why I wouldn't do this outside of just like not being held accountable to this. So it's super valuable tool to see this idea of like adding this much more. It's amazing.
We're really, really pumped to have this type of a discussion, this discussion we get to have with Alex. There's time set aside at Summit for all of you to sit down with your portfolio manager, and we've got all hands on deck to be able to go through this tool with all of you as clients. So I know many of you have already set up your time with your JWB portfolio manager. For many of you, a lot of the discussion will be around this tool. And so we've got 30 minutes blocked off. You get to kind of have the same kind of conversation we just had. And so if you haven't signed up yet for your specific time slot, please reach out to your JWB portfolio manager because we are super, super pumped for all the summit and specifically to kind of unveil this for all of you.
Great, great show, GC. I think this tool is going to be super, super helpful, man. Like I guess the next step is like this, plus then doing the rapid debt pay down, like C3X model, right? That's what we saw with Saran. Like she's doing this, plus she's rapidly paying down stuff, and like is really, really accelerating things. So I think I was like, that's your next homework, buddy.
Hey,
Not that you have enough stuff on your plate.
You know what? We've got the C3X tool, which helps our clients see the accelerated strategic debt paydown, which is phase 2. So today was an unveiling of phase 1 and the tools and the resources to help you get there. But whichever phase you're at, whether it's phase 1, phase 2, eventually phase 3, we're here to serve.
And we are officially 9 days out, single digits from Summit. Next week, we're going to introduce you to someone who's coming to Summit.
Yes.
Came to Summit a year ago.
Yes.
Or 2 years ago. What was it? What was the final?
Last year.
Came to Summit last year, wasn't ready to go.
Right.
Came home, got his affairs in order, figured it out. Got there from in 1 year, was able to become a property investor. He's returning to Summit triumphant, having executed his plan. His name is Greg Roberts. We're going to have him on as the show before Summit. I hope everybody can join us so that you meet Greg ahead of time. You get to know the story. Maybe you walk into Summit a little bit inspired based on what Greg's been able to accomplish in just a year.
I think that word inspire is really appropriate. I got to know Greg last year. He shared his story and his why about how important it was for him to be a rental property investor. I'm not gonna steal the thunder. I want you to show up next week and think about and learn about what was going on in Greg's life because he has accomplished something incredible and it's just such a great story. And you guys are gonna get to meet him on the show next week, and then of course at Summit. He's a champion for this community. I'm excited to share that story with you.
I can't wait. Question from someone in the text: does this work if you're starting with your own home equity?
It does. It absolutely does, right? What we're showing here on this tool is, equity harvesting and deploying the capital. And you can harvest your equity from other places other than your own JWB properties. You can harvest your equity from your primary home. You can harvest equity from maybe your other investments, just like you did when you bought your properties, your first properties. So it helps. Now, it's always nicer if you just take it from the great decision you made from JWB properties, but that doesn't mean that's the only place that you can harvest your equity from. Mm-hmm. So yes, absolutely. That's one thing. And we're happy to walk you through that, just like Alex and the home equity line of credit. You just need to share that information with our team. We can build this entire plan and show you what it'll look like, 5, 10, 15 years down the road for you too.
Love it. I want to give a big shout out to the fairy godmother, Jen Filzen, and to the Grand Amigo, Bill Shields, who saved the karaoke after party.
Yes.
You don't know about this
yet.
Yeah,
what happened?
Well, our usual place was rented where we normally do it. So Bill's going to have a karaoke house party.
No way.
He's hosting us there
No way.
on Saturday night. If you haven't been to Summit, we have a tradition. We do karaoke after the last day. And I have a rendition of Total Eclipse of the Heart that I like to share with people as my gift. That being said, El Gran Amigo coming through big time, Jen coming through big time. We're still going to be able to have a karaoke after party. I want to give a shout out to the 70 plus people that were on this show today.
Man, that's huge, man.
Yeah, that's a big deal, man. Showing up here week after week, a week before Summit, continue your real estate education, continue to connect each other, keep the momentum going in for Summit. Lewis Voiles is asking info on Summit. Lewis, it's next week, but it's sold out.
Yes. So, Lewis might be a lucky ticket holder too. So if you have any questions, you can reach out to JWB, your portfolio. It's for clients only. So Lewis, I'm not sure if you're a client. If you are, you can reach out to JWB, your portfolio manager. We've been making phone calls and sending personal emails to every person who is attending, giving you a lay of the land, things like parking and where to go and all that good stuff. So very personalized approach is what everybody has had. But if you have any questions, reach out to your JWB portfolio manager, and we just can't wait to see you in 9 days.
Can't wait to see you in 9 days. But from now till then, do you see any advice?
Don't